So I'm calling this the Great Migration. Why? Well, for 16, 17 years and 9 years, we have had capital growth and growth in income. And we are now consolidating every client account into discretionary strategies and market proxy. So why are we doing this? Well, first of all, these are not new programs. One of them has been trading a year, the other's been trading almost 8 years. But there is so much overlap in the market, and I'm going to get into that in great detail right now. So the way this looks on a chart here is we're retiring CG and GI. Again, they've been with us since 2011 and 2016, I think. DS has been with us 7 years. MP is right at 1 year. And the reason for this is the overlap in market sector and market cap. So I want to get into that in great detail. There is nothing you need to do. If you have a concern about risk, if you're, for instance, a GI client might say, well, is MP going to be a lot riskier? There is an overlay, an options hedging overlay, which we introduced about 7 months ago. And I'll talk about that too. So just hang with me on this section, okay? So 2 programs under one household. DS is the aggressive, concentrated AI, Mag 7, and quantum growth sleeve of our portfolio offerings, all right? It's signal driven, exit discipline. We have I've talked about this before, our three channel signal. You can go back and watch last month's show or almost any show in the past 5-6 months, and you'll see that. And we do have the QQQ put hedge spread in there. It's hotter than the market by design, meaning most of the stocks in here are hotter than the S&P 500, and it's designed for long-term capital appreciation. Some people will say, well, I'm older and I don't think I really have a need for growth. Well, if you're 70 and you're hoping you're going to make it till 80, 85, you're going to need growth that's keeping up and exceeding inflation for those years. Now, when you get to 80, 85, you probably won't be in DS. You'll probably go back to MP, all right, or something more conservative. But for right now, the money that's in there should be not for money you're going to spend in the next 3 to 4 years, but money you're going to spend in the next 10 to 12 years, all right? All right, so MP, the market tracking core, we call it market proxy, all right? Broad, low cost, tracking the S&P at materially lower risk. So the mix of ETFs in here, this program is 100% ETFs, and its goal is to accurately track the S&P 500 and international exposure, okay? International exposure that never leaves. So in DS, we might have some international exposure from time to time, but if it hits our stop level, we're taking it out, all right? But in the ETF space, we are planning on keeping international exposure. But again, with the dollar so strong, we don't really need to have a lot of international exposure in MP right now. So it's a cap weighted core with an equity income sleeve. That's all in there. We'll get into that in just a few minutes. And it has an optional SPY put spread cushion, no upside cap. All right. For those of you that are really conservative, you've had a lot of your money in GI and you're going, this looks too aggressive for me. The way to protect that's with the SPY put spread cushion. And I'll cover that just in a moment. So why are we retiring these? Both of these stock programs are mostly for individual stocks, and they were built for broad multi-sector participation and hedging. This was back in the day when all 11 sectors in the S&P 500, and there used to only be 10, all right? But the communication services got so large, they had to break it out of the technology sector, and that became the 11th sector in the S&P 500. But as these companies have grown and grown and grown, they are just dwarfing the other companies in the S&P 500. I'm going to show you a chart on that in just a minute. All right. So by design, we were not investing in Magnificent Seven or trillion-dollar companies in CG because we had DS to do that. The challenge has been keeping CG on track to keep up with the indices when it, by mandate, has a limitation on what stocks can it hold. Okay, so in a market this top heavy, and we believe this is permanent, this change in the market is permanent, that structure simply can't keep pace. And the same thing applies to GI. This is a structural mismatch. And again, I believe it's a permanent one, not a bad stretch, not a broken signal. We know what those look like. When we have times when we've lagged in CG and GI, and then we have a phenomenal 2020, we had a phenomenal 2024. but it's gone on now for a long enough period of time that we see that these two are just not going to be able to keep up with the trillion-dollar companies. So that's why we are retiring them. So the market has narrowed to a fewer names, and this is really important to understand. A very small group of mega cap stocks now drives the S&P 500 and the NASDAQ. Technology alone is 38.5% of the S&P 500 and 58%, one sector, just about 60%, okay, of the NASDAQ 100. The same names lead both indices, but in even heavier doses in the NASDAQ. So a diversified hedged book, which is what we had in CG for years since it began in 2011, and a mega cap led index now pull in opposite directions, and that's not helping you. So that's why we made this. And again, I'm stating that I believe this is a structural, permanent change. I could be mistaken. We may go back to where all 11 sectors actually matter and pull their equal weight. But just based on what John said about chip shortages, that's an indicator. You want to know where the market's going, look at SMH, which is the ETF for semiconductor stocks. We have quite a few semiconductor stocks in DS, and we also have just the QQQ index, which carries a lot of different stocks. So it's 100 different stocks, as a matter of fact, that are all technology focused. But the challenge is, how do you keep up with that when you have chip orders that look like they can't even be filled for 3 more years? And then when we get here 3 years from now, it probably will be the same thing again. So the market has narrowed. What does this mean? It means that the AI capital spending super cycle concentrated on earnings growth in a dozen platform and chip names has overtaken everything else in the market. Cap-weighted indices mechanically have to funnel more of every dollar into the biggest winners. That's what indices do. And passive flows amplify this loop. Call it a feedback loop. And the large grow larger by construction, not by choice, but because they have to. So breadth is when you have a lot of stocks participating in a rally, gets fewer and fewer names carrying the entire tape. The tape is the number of stock tickers up on the screen when you're seeing prices go across. That's the tape. When it used to be actual magnetic tape, but it's the reporting of all the gains and losses in a given day, in a given week, in a given month, in a given year. And that tape is getting narrower and narrower. Look at 2018, all right? 18% in 2021, 27%, the top 10 share of the S&P 500. 2024, 34%, 2026, 41%. You can do the math on this. By 2028, half of the market is going to be the top 10 companies. Remember that we also have SpaceX at approaching a little over 2 trillion now. It's gone back and forth because it's been pretty volatile since it started to trade, although it's calmed down. But Anthropic, which is Claude, and OpenAI, which is ChatGPT, will be IPOing at greater than 2 trillion, larger than SpaceX. Okay. So these companies together could be $7 trillion. You remember that number I pointed out to you to remember? $75 trillion. Three companies are almost 10% of that. I mean, it's staggering. So we have to adapt as a portfolio manager. We just do. So look at the left side. That's the leading stocks at the S&P 500. And now here are the leading stocks in the NASDAQ on the right side. A lot of overlap there. NASDAQ, NVIDIA, Apple, Google, Microsoft. And then it varies under that. Sometimes it's a little easier to see this in a bar chart. So let's look at it this way. All right, NVIDIA, Apple, the S&P is blue, NASDAQ is orange or brown, whatever it looks like on your screen. But those huge trillion-dollar companies just suck the life out of the stock market. And you have to be there. You have to be in them, okay? Except for Micron, which is mostly NASDAQ, all of these are pretty fairly represented in both indices. So what is discretionary strategies? Many of you have a DS account. We only made this available. It basically was kind of privately offered to individuals, not companies, for the first 5 years. because it was really volatile. And then we found a way to tame it somewhat with the options hedging and a little more diversification and no margin. Okay. In the early days, we did allow margin trading on it, but we don't now. So the program is systematic and rules based. It is still very much a growth engine. It still uses the CB3 three-channel signal system that I've talked about many, many times, but it's concentrated in the Magnificent Seven, the leading AI and quantum computing leaders. All right. You're not going to find Procter & Gamble in here or Johnson & Johnson or Abbott Labs. Not going to be in here. So signal-driven exit discipline plus the QQQ put spread. All right. That's the aggressive engine of what we're doing. So since 2017, in October, it'll be, 9 years. Okay. 16 holdings, 88 on the nitrogen risk. Those of you that remember Riskalyze, Nitrogen is the company that took that over. And it's built basically with investors comfortable with volatility. But that would be all of you guys, because all of you have a CG account. We don't have a single customer who doesn't have a CG account. And now you're going to have, you don't have to, obviously, we're going to get on the phone and we're going to have conversations. But for the people that know their risk, and we had dialogue, I've started moving people. We're going to have all of this done over the course of this month. So there's no rush. I still have CG and GI in my portfolio. I'm like the captain on the ship. I will not move my last accounts from CG and GI until every client has moved into their target allocation. I'm the last guy on the ship, and that's the way it is. I've always told you I trade what you trade, and I will do that to the last investor. But this is the prudent move for all of us going forward. So it's hotter than the market by design. Since inception, this program, and you can see this if you just go to cb3financial.com and click on performance, all the full detailed reports are there, as well as, let me go back on camera here, as well as the migration plan for how we are moving from CG to DS and from GI to MP. So if you go there, cb3financial.com, click performance, you can choose to download the 2 transition guides, we call them, as well as the performance on DS and MP and also SO. For those of you that are following, that program is going to launch in October. But we'll talk about that right now. So 427% since inception. That's not a double of the S&P, but it's close. All right, pretty strong return, 21% annualized, good Sharpe ratio. You can see the risk-adjusted numbers on the right-hand side and more data than this, of course, on the website printout that I just gave you. Okay, so what's inside the book, meaning what are we holding? So AI, semiconductors, 31%, mega cap platforms, that's going to be your Googles and obviously Amazon, Apple. Quantum computing, okay? Frontier growth, broad technology in QQQ, and then the hedge and cash. So we exited Palantir. I actually had one customer that ask, hey, should I keep my Palantir? And I said, well, you can in your own private trading, but we've exited it in CG and in DS. We also dropped Meta and Microsoft. Now, until recently, we always held a small portion of these Magnificent Seven companies, but these 2 companies are so bad. We did pick up a 10% weighting, in QQQ, which holds every Mag 7 stock at a large amount. And we just decided that that's going to need to be the representation for the Mag 7 stocks that are not performing well. Again, even with the Magnificent Seven, the performance is narrowing to fewer and fewer stocks. And if you're tracking your portfolio, as almost all of our clients do, versus the S&P 500, when we're lagging, it's because we're not highly enough invested in the highest producing stocks. Now, we don't want to just make your portfolios be 2 or 3 stocks. So I hope this narrowing does not exacerbate to the point where we've got to take yet another look at this. But right now, we're very comfortable diversifying, not in 5 or 6 sectors, but in 3 themes. And that's Mag 7, AI, and quantum computing. All right. Again, 16 names in there. We call it the base core and then satellites. Yeah, 10% QQQ. New satellites, GEV, INTC, AVGO. We did add SpaceX. I'll explain why in just a little bit. BWXT. And some of you might say, hey, those are in my CG. Yeah, they are. We took the very best from CG and added them to DS and reduced the size of the satellite. So we have a little bit of diversity here. I mean, we want that for you guys, but at the same time, the biggest engines have to be those stocks that are heaviest weighted in the SPY and the S&P 500 and the NASDAQ. Okay. So the reason that we bought SpaceX so early, and people were saying, hey, I thought you always waited like 90 days. Well, the stock calmed down. All right. And that I took as a real good sign. In fact, frankly, because SpaceX calmed down and wasn't just trading like Tesla's more volatile than SpaceX. It's crazy, huh? But Tesla has a lot of different irons in the fire. SpaceX basically just has SpaceLink. I mean, Starlink, I should say. So in case you're wondering who has the lead in satellites, it's just not even close. All right. The UK, OneWeb, Amazon, China, Russia. I mean, it's just a rounding error. Everybody compared to Starlink. All right. 60% of all the active satellites, more than any other operator, every other operator combined, 10 million subscribers to their internet data service. All right. And it's really popular. Okay. So Bloomberg's take, Russia's Starlink rival is stumbling out of the gates. I mean, they're not even on the map, folks. So that's why we felt we needed to be in SpaceX soon. And why else? Because they're getting added to the NASDAQ. Well, why aren't they being added to the S&P? Well, because the S&P 500, I think, would love to have SpaceX, and they would bump almost anybody out of the S&P 500 because it can never be the S&P 501. Just so you know, this is not the Big 10, which is now the Big 19 or whatever it is. Football fans watching will correct me on that number, but no, there can only be 500 stocks in the S&P 500. And when Anthropic eventually and OpenAI join, they'll have to bump out 2 more companies. But the S&P 500 has a requirement that you have to show profits, I think, for 3 consecutive quarters. And SpaceX not really quite, I think it's 3 consecutive quarters. And then after you've done that, then you qualify. So the NASDAQ does not have that. So SpaceX joins the NASDAQ tomorrow or Monday or Tuesday. I'm not sure when, but we wanted to be there for that because we know that capital will come pouring into the NASDAQ. We believe that it will. It may not be on day one, but it will happen. Okay. So Orbit AI, the largest IPO ever, again, until OpenAI and Claude, right? It's just amazing. They just keep having, and you have to believe, I'm just got to go back on camera again. You got to believe that there are more companies out that are going, well, looks like we got to come up with enough acquired companies we can add to our own company to make our IPO at least $2 trillion. I think you're going to not see certainly $100 million companies IPing anymore. If so, they're not even going to get mentioned in the news because they don't move the market. So the era of the $1 trillion IPO, multi-trillion dollar IPO is on us. All the more reason why you cannot beat an index unless you are in those players. You can't. You just can't do it. So inside this IPO, all right, 135, now trading about 156. I think it closed today. All right, peaked at 225. That was on day one. So Starlink, as I mentioned earlier, that's the profit engine. Grok, their AI entry is just burning cash, not doing anything. And their launch technology, that's the backbone, okay, Falcon 9, Starship, mostly flying Starlink satellites, okay? That's what they're in business to do because they can get paid to put satellites in space. All right, so it's a fundamental story. Their sales, 73 times, you're paying 73 times sales for Starlink and essentially SpaceX, and Meta's only 16x. All right. So you're really paying up for that, which is why we have only a 2% position in this, because we realize it could be a rocky ride. But eventually, if Musk's dream comes true of putting satellites in orbit around many planets in his lifetime, I mean, he's even talking about having 1 million people living on Mars before he stops breathing. He literally said that over the last month or so. So We need to be a part of a company that dreams that big. Maybe not a huge part, and certainly not in MP, but we need to be in DS in that because you want to catch those huge winners, even if you have small positions. So, all right. So let's talk about market proxy. So, as its name implies, we're basically trying to mark the profits and losses and gains and everything that goes with the actual S&P 500, but do it with less risk. So we're doing it calculatingly with 6 ETFs right now. We can go up to, I think, 12 is what we listed in our prospectus. I don't think we'll ever need that, but right now we have 6. We change their weights almost every month. And we did this month. You'll see what that looks like in just a few slides here. But it's built to track the broad market closely at a materially lower risk. That's what allows MP to be a good fit for GI investors. All right. So MP is the account of record for the GI investors. If you got questions, CB3 at cb3.com. You know our phone number, 312-513-7486. Give me a call. But that's why we're doing this. And we can put our SPY put spread sleeve, that's to protect on the downside. If you are a very conservative, we have 2 already that have asked me to do that on their MP account, which we gladly do. Okay. Nitrogen risk at 70%, which is under the risk of the market, which is between 76 and 77, does spin off a decent amount of income too. And so it's returned really pretty good here, 16% over a trailing year. All right. S&P at 1609. So basically, the same amount. During downturns, it tends to drop less. You can look at the track record. Again, just go to CB3 Financial/performance and click on the MP fact sheet, and you'll see that performance right there. It's about 70% of the market volatility, very strong Sharpe ratio. 90% of its months have been positive. Okay. Just last month, S&P down 1.1%, market proxy up just a tiny bit. I mean, that's what we want to see. Lower beta, which means lower volatility. So you're not going to get rich in this program, but you more than likely are going to have very close to market performance at lower volatility. So really, that's why we're here with these 2 programs. For right now, unless something changes, and I've stated earlier in tonight's program that I think these changes are permanent as anything can be in the market. If we have chip orders that aren't going to be fulfilled for at least 3 years, and we have nothing but trillion-dollar companies, at least substantial nothing, coming to the market for IPOs, you got to be in that space. You just do. All right. And obviously, you're going to do some weighting changes. I mean, SpaceX could grow in weighting. We might open Anthropic at 1%. Don't know yet. Don't know what the data is going to be when it actually launches. But that's where we have to be. So ETFs make sense here. We have one for the broad market, one for large cap value. So those are stocks that are beaten down. But again, we can invest in this ETF anywhere, in energy, in healthcare, in consumer cyclicals, utilities, consumer staples, anywhere, international developed markets. Now, there are still great companies overseas in Asia and Europe. They're just small, all right? And they don't move the needle, and they are usually, well, almost always traded in the native currency. So if you're a German company, you're going to be denominated in euro. If you're a Tokyo-based company, you're going to be denominated in yen. And those currencies, the yen just hit a 35-year low versus the dollar. I think it was 2 weeks ago I saw it. It's crazy. All right. But we still want some exposure there. And then we have U.S. small cap value. So these are small cap opportunities, 9%, again, diversified over I think 150 different stocks, and a very small percentage of bonds. Now, if that's not enough bonds for you and you want that downside protection, we will put the option hedge on for you. Okay. On the right-hand side, you can see the changes we made this month. We are frequently changing the tilt, we call it, which is the balance. We might move the large cap holding from 36% up to 38, and then the next month down to 35, depending on what we see is trending in those different asset classes. Okay, that's how this program works. So the insurance that I mentioned, you insure your home, you insure your automobile, you can insure your portfolio. We've been doing this in CGGI and DS. We will continue to offer this in MP. Most people probably will not need this because you do have the QQQ protection in your DS account as you move from CG to DS. And we do have that component of bonds in MP, which will give you some downside protection. So it will soften a sharp decline. It'll reduce the depth of a drawdown. And again, we have a brochure on the website where you can see this. If you want to see more about it, or you want to talk specifically about it with me, just give me a call, shoot me an email. We'll set up a time and we'll talk. This is an opt-in on a per client basis. I'm guessing almost all of our clients are going to have MP accounts and almost all will have DS accounts. A few will just have MP, a few will just have DS, but most of you guys will have both. All right. And, we can talk about whether the options hedging on both your programs makes sense. It's going to be on DS. It has to be because it's just too volatile. All right. And we've seen that pay off for us. So that's how they fit together. So concentrated upside from AI, Mag 7, and quantum, higher volatility, deeper drawdowns by design, but you saw the returns, 427% versus the S&P at just a little over half that. Okay, that's where the growth is meant to come from. MP, on the other hand, is broad market exposure, 70% of the risk, lower beta. Beta is the volatility of a portfolio versus the S&P 500. If the S&P has a perfect beta of 1, all right, so if your portfolio is 0.7, your 7/10 or 70% is volatile. If you happen to notice on the DS, it was 122, so it's 22% more volatile. That's where you pick up the opportunity for growth, okay? Most people, if you're drawing on income, you're not going to be drawing it from DS. You're going to be drawing it from MP. So the weighting of your portfolios is important. And I make it a point to talk to each of you that wants to talk about this. I know how I think you should be allocated, but if you have questions, I think my first appointment opening, I'm booked tomorrow, but I've got noon to, 5 o'clock on Friday if you want to talk about this. Okay. So again, most households will hold both, right? It just makes sense. Folks, that's it. That is the show. That's everything I wanted to talk to you about tonight. If you're new to the program, please click the little bell on YouTube, which will give you a notice every time that we go live. And also, if I upload a program that is not live but pre-recorded, and there may be some of those coming up, we continue to have new announcements and information for you guys. Follow me. I tweet every single day unless something happens, I get sick or whatever, but Facebook, X, and LinkedIn. And our next show, Thursday, August 13th. Thursday, August 13th. That's 5 weeks away. All right. So in between now and then, since it is 5 weeks, I will be doing my podcast. We've done these for a couple of years now. We don't have a huge audience, but I do these audio updates usually weekly, sometimes every other weekly. If you have a topic you want discussed that's in between shows, especially these times when we're like 5 weeks between a show, let me know what that topic is and I will cover it on the podcast. Okay. So the word for today, rule number 1, most things will prove to be cyclical. Rule number 2, some of the greatest opportunities for gain and loss come when other people forget rule number 1. And it's for that reason we don't predict the cycle, we respond to the signal. Let me read that again. We don't predict the cycle, we respond to the signal. There's another way to put that. Another way to put that is, well, we don't have an ability to necessarily predict the market because our ability for which you pay us is our ability to most quickly respond and react and implement change for your portfolio to what's happening in the market. Our ability to react is far more important than our ability to predict. I always leave you with this from 2 Timothy 1:7. For we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. And that helps us in times of uncertainty like we are going through right now. It must seem a little strange to you that um, our president seems like it just seems like they're making up the policy. I'm going to get in trouble with my friends on the right here, but just making up the policy as they go along with Iran. I don't know. But the market just seems to blow it off. Why? Because what are the most two important features of stock market returns? The Federal Reserve and their policy on interest rates and earnings. Are earnings good? Yes, they are. If we come back here in August on the 13th and that 88% beat rate, which we have right now, granted, it's only what, 17 stocks, but by then it'll be 250, 260. Okay, more than half. All right, if that's still at 88%, market's going to be at lifetime highs again, almost no matter what's happening with the war. So don't let it get you down. All right, we got you covered. We've got you covered on our monthly show, on our podcasts, and on my daily tweets. If you have questions, please give us a call. I think you're going to be excited to see a simplified program. Some of you have had all four accounts, all four SMAs, and there's been overlapping coverage. So now we have two very targeted, specific task programs that are built for the environment, the culture of a $1 trillion company market. We thank you for watching. You guys mean the world to me. Thanks so much. Alice and I are just grateful you're here. Have a great continuing summer. We'll be back in August. We'll see you then.